welcome to the channel Creative Wealth. Before we start our video today, I would request you to subscribe to the channel if you have not done. And if you feel that there is some story which we should know, please write it down in the comment section. Please click on the like button, click on the bell icon to stay connected.
Dhando 201. Invest in distressed businesses in the distressed industries. Efficient market theorists (EMTs) tell us that all known information about a given publicly traded business is reflected in its stock price. Thus, they proclaim that there isn't much to be gained by being a security analyst and trying to figure out the intrinsic value of a given business. And with frictional costs thrown in, the EMTs believe that the stock pricing is not just a zero-sum game, but rather a negative sum game. Here are Mr. Buffett's replies to them. I would be a beggar on the street with a tin cup if the markets were always efficient. Investing in a market where people believe in efficiency is like playing the bridge game with someone who has been told it does not do any good to look at the cards. It has been helpful to me to have tens and thousands of students who have been turned out of business schools, and they have been taught that it does not do any good to think. Current finance classes help you to do average. Mr. Buffett has been cherry picking at stocks for 56 years now, and from a standing start have a fortune value of more than 40 million today. Nonetheless, I mostly agree with the EMT's stock price and their concepts. In most instances, they do reflect that the underlying fundamentals. Trying to figure out the variance between the price and the underlying intrinsic value for most businesses is usually waste of time. The market is mostly efficient. However, there are huge differences between mostly efficient and fully efficient. This is the critical gap that is responsible for Mr. Buffett not being a street corner bum. In the letter to the stakeholders for Berkshire Hathaway, Mr. Buffett in 1988 wrote a wonderful section on EMTs. I strongly recommend reading it. All the shareholders received this letter on the Berkshire Hathaway's website, and there is a treasure of wisdom over there. I would be creating a separate video on it so that you can also listen to it. Observing correctly that the markets are frequently efficient from academics and Wall Street's point of view went on to conclude incorrectly. It has always been efficient. The difference between these propositions is night and day. Markets aren't fully efficient because human controls the auction-driven pricing mechanism. Humans are subjected to vacillating between extreme fear and extreme greed. When humans as a group are extremely fearful, the price of the underlying assets are likely to fall, and it will fall even below the intrinsic value. When there is extreme greed, it's likely to lead to an exorbitant high price. If a business owner is extremely pessimistic and fearful about the future of his business and decides to sell it, it is likely to take him several months to get a sales consummate. In case of the stock market, an individual investor is the same doom and gloom mindset. He would likely have uploaded his entire position in a few minutes. Hence, stock prices move around quite a bit more than the movement of the underlying intrinsic value. Human psychology affects the buying and the selling of the fraction of the business on the stock market, which more than the buying and the selling of the entire business. Mr. Market, a creation of Benjamin Graham, lives in the stock market and is a very hyperactive and a moody character. He is buying and selling tiny fractions of several thousand business every few seconds. The price at which Mr. Market buys or sells is not based on the intrinsic value of the underlying business. It's determined by its mood. Change in his mood immediately results in the price change. Mr. Market's perimeter approach of setting the price could not be more different from the way the prices are determined from the sale of the entire businesses. With the rapid fire trading of thousands of security, every once in a while a few stocks might have a great deal of bad news. This sometimes leads to extreme fear and the wholesale unloading of the stock. But when you sell a stock, there will be buyers on the other end. The buyers are looking at same bad news as you are. The only way such a sale gets a consummate is a deeply distressed price. Papa Patel, Manilal and Mittal all made their fortunes by fixing on buying a distressed business. Most of the time, they did it when the entire industry was severely wounded. The motor industry right after 9/11, the bankruptcy-ridden steel industry in 1980s and 1990s. The advantage we have over them is that our playing field is much larger. There are thousands of stocks whose price wiggle around all day long. All we need to do is to first narrow down our universe of candidates, shortlist the business and decide on what we have understood well and which of them are in the distressed state. How do we get a list of distressed businesses or industries? There are many sources, but let's begin with 6 of them. The first source. If you read the business headline on a daily basis, you will find plenty of stories about publicly traded businesses. Many of these news clips reflect negative news about a certain business or industry. For example, the Tyco stock collapsed when the scandal was announced. The Maratha steward prison sentence collaborated the stock. To take examples from the Indian stock market, Satyam's stock price fell down drastically. The latest news was on the PNB and the scandal that came in. These stories are becoming the headline stories. Source number 2. Value Line publishes a weekly summary of the stocks that have lost most value in the preceding 13 weeks. This is another terrific indicator of distress. This list of 40 stocks routinely show price drops of 20 to 70% over that period. The one with the largest drop is likely to be the most distressed. It also has a summary every week of the stock with the lowest PE ratio or the price earning ratios, the widest discount on the book value, the highest dividend yield, and so on. Not all these businesses are distressed, but if the business is trading at a PE of 3, it's worth a closer look. The source number 3, there are publications called as portfolio reports, www.portfolioreports.com, that are published monthly. It lists 10 most recently stock purchased by 80% of the top value managers. It glints into information from the various fillings that the institutional investors are required by law to make. These managers aren't 100% focused on the distressed situations, but they are focused on value. Distressed situations are subset of value investing. So some of their investments fall into the distressed category. Point number 4. If you are like to avoid subscription price tag for portfolio reports, then much of that data can be gleaned by looking directly into public filing. Example, SEC Form 13F. So these are for US market, and the information relating to the Indian stock market can be found on the BSE and the NSE websites. Point number 5, take a look at Value Investors Club, VIC, or www.valueinvestorsclub.com. This is a wonderful website started and managed by Goel Greenwald of Gotham. And the similar information is available in the Indian context at moneycontrol.com. There is a new website which has come up, that is Mojo Market, and the other one which you can obviously look at is Value Research Online, and they also have a subscription of a monthly magazine called as Wealth Insight, which focuses on the stock market. Point number 6, last but not the least, please read the book, The Little Book That Beats the Market by Mr. Goel. After reading this book and then visiting the site magicformulainvesting.com, like Portfolio Reports and VIC, not all the stocks on the Magic Formula website are distressed, but a meaningful number are. We will be covering a little bit on the Magic Formula later. Between these sources, there is a lot of information about the candidates of the distressed business to examine. How can we get our arms around all of them? Well, we don't have to. We begin with eliminating all the business that are either not simple business or fall squarely outside our circle of competency. What's left is a very small handful of simple, well understood businesses under distress. We are now ready to apply the rest of the Dhando framework in the selected group. We will continue in the next video about the Dhando 202, invest in business with durable moat. I would request you to write your comments, your observations, and anything that you would like us to know. Please click on the like button, subscribe to our channel, and share it with your friends. Thank you.